Welcome to the Daily Insights That Matter. We will begin today's DITM by talking about Suzuki Motor Corp's plan to set up a global R&D company in India. Suzuki Motor Corporation will be setting up a global research and development center in India with the aim to push deeper into a market that is set to become an EV hub for the Japanese car maker. Suzuki aims to strengthen its R&D competitiveness and capabilities in new fields of technology not only for India but also for the global markets as well. Furthermore, it will strengthen ties with the Indian academic institutes and startups to develop diverse human resources. Suzuki's president, Mr. Toshihiro Suzuki, said India has become one of the most important countries for Suzuki Group and it will continue to invest in India aggressively. For Suzuki, India is one of the largest markets in terms of revenues and also profits, and it is also one where it has invested approximately 65,000 crore rupees to support Maruti and ensure it maintains its leadership positions. While commemorating 40 years of Suzuki in India, Prime Minister Shri Narendra Modi ji laid the foundation stones for Suzuki's electric vehicle battery manufacturing facility in Gujarat and for Maruti Suzuki's car manufacturing facility in Haryana. Interestingly, more than 60% of Suzuki Group's 2.8 million automobiles produced all over the world last year were made in India. While Suzuki's 40-year association with India is a symbol of strong India-Japan relationship, Suzuki's move to set up a global R&D facility in India will strengthen the EV ecosystem, specifically at a time when India is pushing for car makers to build more and more electric cars through the production-linked incentive. Additionally, Suzuki's plans fits in very well with the country's plans to lessen reliance on oil and also lower the harmful air pollution in larger cities. The US Federal Reserve Chairman Mr. Jerome Powell delivered a keynote address at the Kansas City Fed's annual policy forum in Jackson Hole. While the keynote speech lasted for 8 minutes only, it managed to rattle the markets globally. Now, Mr. Powell's speech made it clear that the Fed is likely to keep raising interest rates to stamp out inflation, which is at decade highs currently. This defied market prediction that in light of a potential inflation peak, interest rate increases would slow down during the forthcoming few quarters. Now, the US stock market stumbled with all the three main indices, the Dow Jones, the S&P and the Nasdaq, ending in red with losses of 3% or more on Friday. In the span of just 8 minutes, Powell's speech sparked a market rout that slashed the fortunes of US billionaires by close to $78 billion. The Indian equity markets also took a beating early this week, mirroring the Wall Street rout on Friday. The Sensex crashed by 1,150 points or 1.96% to 57,680.87 and the Nifty 50 slumped 337 points or 1.92% at 17,221 points at the opening on Monday. Additionally, the Indian rupee declined 26 paise to a low of 80.1 against the dollar. This was consistent with other Asian currencies that also declined as a result of the stronger dollar after comments made by the Fed Chairman Jerome Powell. The dollar index, which measures how the dollar changes in value relative to a basket of 6 important international countries, increased 0.4% to 109.31. While the Fed chairman's comment is expected to keep Indian markets on the edge and can negatively impact Indian equities, the robust Indian economic growth could help navigate external challenges and has the potential to attract large foreign inflows. Indian equities have remained resilient for much of this year despite a continued withdrawal by the FIIs. This resilience should be viewed as reflecting of the strength of the structural story, which well remains intact. Many top-rated companies are shifting to the local bond market for their borrowing needs while reducing their reliance on the banks. This is due to the marginally lower interest rates and the easier terms that they tend to get from the bond markets. While these may be early days, but many AAA rated corporates are borrowing funds by selling bonds instead of opting for the floating rate loans amid a rising interest rate scenario. Since June, approximately 1.45 trillion rupees worth of funds have been raised via bonds and non-convertible debentures according to the data compiled by Prime database. This is a jump of approximately 15% as compared to the same period last year. For a AAA rated corporate, a 2 to 3 year bond is now available at interest rates between 7.15 to 7.45%, whereas a 3-year bank rate is available at 7.3% to 7.5%. Most of the funds are being raised by these companies mature in 2 to 3 years. Infrastructure companies, especially those in the road and telecom sectors, non-bank lenders, state-run companies, and many banks have been issuing bonds. Now, what's important to note is that there is a larger traction from the AAA rated corporates only, and the non-AAA rated companies still prefer the loan market. Now, we need to look at this from various perspectives. Now, from the perspective of a corporate issuing bonds, this is a big plus as it gives them a cheaper source of raising funds at fixed rates of interest, especially during a rising interest rate regime. Now, the bond issuers must be wary of the fickle-minded investors who may look to cash out on short-term opportunities, but as they form a very small part of the overall investments, they need not worry much. Now, looking at it from the perspective of an investor, this opens up new avenues of investing for us. While the overall asset allocation of your portfolio and the proportion of your portfolio to be parked in debt may be best indicated by a financial planner, the bond market provides as an additional debt instrument which can form a part of your portfolios. Now, looking at it from the perspective of a bank, the banks don't seem to be complaining as the banking sector credit growth continues to remain strong, expanding 15.8% from a year earlier as of 12th August. Now, according to Reserve Bank of India data, loans taken by the large companies have also seen a growth of 3.3% in June from a year earlier, and this is the fastest since the outbreak of the pandemic. With the onset of the festive season, retail credit will also pick up going forward. Hence, this looks like a win-win situation for everyone at this stage. Now, what does all of this mean for you? With a 40-year rich history, Suzuki's plan to further set up a global R&D company in India comes at a time when India is looking at various initiatives to strengthen the EV ecosystem within the country. This will have an indirect positive impact on you. Jerome Powell's speech clearly indicates that the economic growth might be compromised in the process of taming the multi-year high inflation. The weak global cues may put a temporary brake on the Indian stock market rally, and hence it will have a negative direct as well as an indirect impact on you. Now, the increased bond issuances by larger companies is a big positive for the corporates as it helps them borrow at a marginally lower rate and also opens up more diversification opportunities for the investors. Hence, it will have a direct and an indirect positive impact on you. In our efforts to bring you the insights that truly matter, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.